Navitas Semiconductor is currently trading at $21.56, marking a significant intraday climb of 11.25% as of 4:30 a.m. EDT on May 14, 2026. This movement follows a period of intense volatility and a massive run-up that has seen the stock gain over 95% in the last month alone. While the broader semiconductor sector has been grappling with fluctuating demand in consumer electronics, Navitas has managed to decouple itself from the pack by positioning its hardware at the center of the infrastructure required for high-density computing. The stock reached a 52-week high of $23.82 just days ago, and today's price action suggests that the market is aggressively repricing the company's role in the power management supply chain. The immediate expectation for many retail traders is that Navitas is simply another small-cap semiconductor play riding the coattails of a general tech rally. However, the reality is far more complex and arguably more lucrative for those looking at the structural shifts in data center design. While giants like Nvidia stock dominate the conversation around the processors themselves, the power delivery systems that fuel those processors have become the primary bottleneck for performance. Navitas has successfully demonstrated a solution that eliminates traditional intermediate stages in power conversion, which has caught the attention of institutional investors who are now moving into the stock with significant conviction. This shift from a niche component provider to a mission-critical infrastructure partner is the real driver behind the recent price surge, and it is a development that many casual observers have yet to fully price in. When you look at common sentiment, there is a belief that the easy gains in the semiconductor space are already behind us. Many investors are retreating to the perceived safety of established names like Apple stock or Tesla stock, assuming that smaller players lack the balance sheet to compete during a high interest rate cycle. But if we challenge that logic, we see that Navitas is operating in a specialized domain where incumbents are struggling to pivot. The transition from traditional silicon to wide-band gap materials like gallium nitride and silicon carbide is not just a marginal improvement, it is a fundamental shift in how electricity is managed. By specializing in these materials, Navitas is effectively creating a high-moat business that the larger legacy semiconductor firms are now trying to replicate or acquire. Recent trading volume has been exceptionally high, often double or triple the 30-day average, indicating a massive rotation of capital. This isn't just retail enthusiasm on the Robinhood app. We are seeing substantial institutional accumulation. Major wealth management arms and those utilizing Fidelity Brokerage or Interactive Brokerage Platform are increasingly flagging Navitas as a top-tier pick-and-shovel play for the next generation of energy-efficient computing. The company's recent Q1 2026 earnings report served as a major catalyst. Although they reported a net loss of $33.79 million, the revenue beat expectations at $8.6 million, representing an 18% sequential growth. More importantly, management's guidance for Q2 revenue to hit the $10 million mark has signaled that the ramp-up in their high-power market segment is accelerating faster than analyst models had predicted. The tension in the stock right now stems from the company's recent filing of a $250 million shelf registration and a $125 million at-the-market offering. To the untrained eye, a capital raise often looks like a sign of weakness or impending dilution, but in the context of the current market, this is a strategic war chest. Navitas is preparing for a massive scale-up in manufacturing and research to support their partnership with the largest GPU manufacturers in the world. Investors using SoFi Invest or Schwab Intelligent Portfolios to manage their risk may see this as a high beta opportunity, but the underlying data suggests the company is trading on a transformation of its business model rather than just speculative fever. The addition of industry veterans like David Lee and Gregory Fisher to the board further substantiates that this is a company moving from its startup phase into a serious industrial competitor. If you are looking at your individual brokerage account today and wondering why the market is rewarding a company that is still technically losing money, you have to look at the gross margin expansion. Navitas saw margins tick up to 39% this past quarter, a clear sign that they are gaining pricing power as their technology becomes indispensable. This isn't just about consumer chargers anymore. They are moving into grid infrastructure, solar energy, and industrial electrification. The volatility we are seeing today is the market trying to find a fair valuation for a company that could potentially own the power management layer of the AI data center. Comment below how many shares of Navitas Semiconductor you currently hold, or if you are waiting for a pullback to 18 before entering. It is always interesting to see how the community views these high-growth names compared to the steady performance of something like a Fidelity ETF or a diversified intelligent portfolio. Taking a step back to look at the business itself, Navitas Semiconductor was founded with the specific intent of replacing legacy silicon power chips. Silicon has served the industry well for decades, but it has physical limits regarding how much heat it can handle and how fast it can switch electricity. Navitas pioneered the GalFast technology, which allows power systems to be smaller, lighter, and more efficient. Initially, this was seen mostly in high-end laptop chargers and mobile devices, but as the world moved towards electric vehicles and massive AI clusters, the need for efficient power conversion exploded. Their GeneSiC technology focused on silicon carbide allows them to handle much higher higher voltages, making them a direct competitor in the EV and renewable energy markets. The competitive landscape is fierce, but Navitas has a first-mover advantage in the integration of power and control circuits on a single chip. This integration is what allows their customers to reduce the overall size of their power supplies by up to 50% while increasing power density. For a data center operator, every square inch of space saved and every watt of heat reduced translates directly to millions of dollars in operational savings. This is why the narrative of Navitas is shifting. They aren't just selling chips, they are selling efficiency and thermal management at a time when power consumption is the #1 concern for the tech industry. Looking ahead, the catalysts are clearly defined. We have the upcoming earnings call in August 2026, where the market will be looking for confirmation of the $10 million revenue target and further details on the high-power pivot. There is also the potential for major design win announcements at upcoming investor conferences. The risk, of course, remains execution. With the new capital raise, the company has the runway it needs, but the pressure to deliver on these high-power contracts is immense. If they can maintain their 30% plus growth rate in the AI segment, the current valuation, which some might call stretched, could actually look conservative in hindsight. The contrast between the expectation of a volatile small cap and the reality of a fundamental technology shift is what makes Navitas such a compelling study right now. Most investing sites will focus on the net loss, but the sophisticated investor is looking at the design pipeline and the institutional rotation. Whether you are trading through Robinhood stock trading for the quick swings or holding through Fidelity Wealth Management for the long-term thematic growth of AI infrastructure, the narrative remains the same. The world is getting more power hungry, and Navitas is building the tools to manage that hunger. In summary, Navitas Semiconductor is currently at a critical juncture. The intraday jump to $21.56 is a reflection of the market finally acknowledging the company's successful pivot to high-power markets. While the initial expectation was for a slow recovery in consumer electronics, the reality has been an explosive demand for AI data center infrastructure. The company has secured the capital it needs to scale, strengthened its leadership, and demonstrated that its technology can maintain high margins even during a growth phase. The authority Navitas is building in the gallium silicon space is undeniable, and as we move into the second half of 2026, the focus will stay on their ability to convert their impressive design wins into a consistent, profitable revenue stream. The gap between what the average investor sees as a risky semiconductor play and what the deep dive analysis reveals as a structural necessity in the AI stack is where the real opportunity lies. As always, the market will continue to test these levels, but the current momentum suggests that the conviction behind this move is backed by more than just speculation. It is backed by a fundamental shift in the global demand for energy efficiency. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involved risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.